Hello, traders. It is Thursday, the 20th of June, 2019. Thanks for coming in here today. This is the day after the Fed, and the market is really rocking and rolling overnight. We've pushed the all-time high in the ES, which was formerly 2960 in the September contract. If you're still on June for whatever reason, that number was 2956. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Hopefully you can hear me loud and clear. I'm on a different mic today. Um, so the sentiment overnight, my quote board is all positive, all blue, with some significant rises. Crude oil leading the pack. Crude oil jumped $2 on the August contract, trading at 56.15 or up 4%. Crude oil is the move in crude oil is attributed to news that Iran had shot down a U.S. drone over its waters. And that the expectation is this is likely to escalate conflict in the Gulf and likely to cause supply disruptions. So crude is responding by, the classic supply-demand curve. The market foreseeing some supply issues. So the price has popped. Gold is higher. Gold is trading at 1,387, up 2.84% following the Fed's comments. The Fed had released comments relating to, in case you're not here yesterday at 2 p.m. Eastern, the Fed is softening its view. It's becoming dovish in terms of interest rate drops. And so the Fed is saying that it's ready to accommodate as early as July. And that's really what the key driver behind this pop higher. The S&P is experiencing a gap currently of 30 points from the prior day's close, about 27 points or so from the prior high, and that's where we are. So risk on sentiment today, and we're moving forward. As far as what's on deck, what's on the calendar, remaining, Russia just reported, and we're looking at consumer confidence. Russia just reported on unemployment. It says it's at 4.5%, which actually seems really low, but consumer confidence, Eurozone consumer confidence comes out at 10 o'clock, a half hour after the open, 10 o'clock Eastern. And BOE's Carney speaking at 4 p.m. Eastern. And then tonight, Japan releases its inflation rate year on year at 7:30 Eastern. Nothing else is scheduled. However, it's really important to understand that with the central bank moves and continuing geopolitical news, including, by the way, which I didn't mention, the door is starting to crack open again from both sides on the China-U.S. Trade talks. China is basically saying, look, if you come to the table with a reasonable plan, then they would like to make a deal. So those things are positive as well. So that's where we stand this morning. Let's take a look at yesterday's expectations versus what we got. Now, I want to remind you that the goal of the scenarios that I create is not to be right or wrong. If you are here, call this a trader wisdom segment. Actually, two things while I'm at it, and maybe it's because this is the 1,540th episode of the Trader Bite. But two things. If you are here to trade, if we were all here to trade, to be right or wrong, it's a path full of a lot of suffering, a lot of expense, and a lot of lost time, and a probable abrupt end in which we need to go and do something else. Our goal is not to be right or wrong. This is not, just get that out of your dictionary and get that out of your mind. You're not trying to be right as a trader. I know that sounds wrong because we all think that we make money when we are right. No, we make money, I'm included in this, we make money when we place a bet with a probabilistic outcome that is in our favor, and we place it enough times to see our edge play out. Period. It's a numbers game, it's a mathematical game. It is not about being right. So I saw a comment in here that a bunch of people responded to yesterday saying, when is this guy right with these scenarios? My scenarios are intended to be right. You're missing the point if you think that I intend to predict. I mean, it's crazy pretending to predict where the market is going to go. No, my intent here, it's like a general predicting how a certain battle is going to play out. That general will probably get fired right quick because of the enormous loss of human life and men and women of the armed forces. You can't do that. What you do as a general is look at the information in the context and plot a plan for how things may play out so that when things do play out, you have all the pieces and resources for us, execution, risk assessment, and trade management in place to take advantage of that outcome, right? So, plotting some lines on a chart here in front of you doesn't mean that I know something that you don't because I'm quote unquote a professional trader. I'm professional because this is what I do and I've done it for 19 years. I'm a licensed trader on Eurex. I'm a member of the CME. I've run a prop group. I've traded for myself and for others, and so on and so on. And I don't do it. That's what makes me a professional. A professional trader does not mean they're right. Okay, because I could be someone who has a $10 million account trading 3 lots in the MES full time. That could make me a professional trader. It doesn't make me right. So that's one point I want to make. The goal here is not to be right or wrong. The goal here is to have a plan for when the market shows us the possibility. And there are 5 plans every day. 5 plans. Because things can happen. There are 5 basic things that can happen in the market, and I'm looking at which one may play out. I cover the first and second because we're trying to keep this short. The second point are comments and emails that I get about stop being political. And this is not a rant. This is just me trying to be very transparent and clear as I always have. If as a trader I want to sit here and not criticize what a government, whatever government it is, domestic, foreign, whether it's Democratic, Republican, green, yellow, or blue, I don't care. If they're doing something wrong and the price is and their actions are impacting the market, you better believe that I'm going to comment on it because otherwise I just have blinders on. If we have a president that is constantly tweeting at times about on things that impact the market on a random basis, and you hear me saying, look out for these tweets, the tweeter in charge, and that offends you because you're a supporter of this president, then I question the basis on which you support this president. I made the same comments about Obama and about Bush before him with the wars, and Clinton before that when I was investing in stocks in college. So it's really important for us not to put our blinders on. We as traders have to see facts as facts, and when people are being idiots or irresponsible or unethical, you can have your own opinions, but let's face the facts. Let's not get caught up emotionally in politics. Politicians don't care about us. Politicians care about holding on to their spot, their seat, their power, and their influence because they get paid that way. And so overall, if you're somebody who stops watching or unfollows or whatever because you feel like I'm being political, guess what? Whatever president's holding on to that seat, they're going to get it from me because if it impacts how we trade, they're going to hear it. So not that they care, not that my voice makes a difference, but if you're getting upset because I'm commenting about a president that you support, then you're not being objective about what is you're not being objective about what is influencing the market, and we cannot ignore geopolitics. Back to business. So yesterday, the expectation was for a complete sideways market. Now, I drew scenario one here as completely sideways for a while with a break lower and a break higher, and then the market likely to take off or fall from there. Hard to say after the FOMC. This line here represents the FOMC. When I drew this, I knew that it may be a little bit exaggerated, but holy cow, was this market locked in yesterday into just a dead zone. So let's go back to the way things looked like before 1 o'clock my time on my Renko chart. This chart put in an opening swing high, and an opening swing low, and did not breach them for at least 2 hours, which is quite amazing that an opening swing holds on to its terrain for that long. And then it broke to the downside as anticipated. It broke to the downside, went down into the 29.15 stock zone, and then it turned back up as the Fed announced. So the Fed announced at 1 o'clock at 13 hours, 1300 hours my time, and this was what ensued with the Fed. Had an area from the day before at 36.50, 37, and it ended up pushing to that area. It's really the Fed overall had a pretty decent, okay volatility, but in general, it didn't really push that far. Um, it didn't really push that far. But overall, look at the scenarios, which are wrong all the time apparently. Not that I care, but look at the scenarios. Here's the oops. Here's the complete consolidation, the break lower, the break higher, and then it just hangs on to this high. Now, does that make me right? It doesn't. It just means there's something. Um, it just means there's something that is likely to take place, and it just happened to play out. Okay, again, it's not about right or wrong. From here, looking at the profile yesterday, clear price discovery after this crazy consolidation in the middle. After this crazy consolidation in the middle, a clear rejection. There's an excess low here at the low following the Fed. A clear excess low, and the market just could not visit that again. And the expectation is that the market is likely to drift higher. The ES is likely to drift higher overnight, and that's what it did. It reopened, and it just took no time at all to continue to push higher. And the overnight profile, the extended hours profile, displays that the market's in complete price discovery mode, and it keeps pushing highs. Currently at 29.64 and a half on decent volume. The pace of the roll from the CME that URL I showed you on the CME site. It's called Pace of Roll. You can look that up. Shows that we're at about 80%, which is about where we stop in terms of essentially what that chart is saying. Is about 20% of the open interest in the ES is actually delivered or settled at expiration. In other words, people taking there is no physical delivery, but people holding positions into the close at 20%, and 80%'s already been rolled. So the volume numbers, the delta, the volume delta figures, and so on, should be a lot more true. Should be a lot more true and more reliable going forward from today. So look at the pace of roll and make sure you understand how that works. The high overnight is very weak. The point of control is near highs. The market's traded quite a bit at 29.6225. That's moved up from 29.50 just now, and it looks like it has not found its sellers yet. We're in new all-time high territory, and for that reason, let me pull up. What are these idiots doing here? One of my news feeds. They're just making a lot of noise. One of the things we want to look at here for a minute is the composite is a composite to see where we are, and from here on out in this territory, we are in new high territory, and so that means that means we have no reference points going back, right? This is a new all-time high. There's your V bottom. It's time that I took this profile off, and you can see there's the V bottom there. These bars represent each bar represents one RTH session per bar, and with a clear retest of the MC point of control and the composite point of control before the market took off again, and now it's gapping higher into new all-time highs, trading at 29.63. The prior all-time high is 29.60. Okay, and so that's what we've got, and this means that now I have to start doing projections, measured move projections, to figure out where turning points might be, exhaustion might be, and so on. Okay, looking at so that's just a review. I don't have any reference points above other than projected ones. And so let's take a quick look at the order flow on CT Bookmap. Let's see, this should be at 100. So looking at the order flow so far, so we see some pretty heavy order flow down at 29.30, 175.32, and we're far away from that. But in terms of what has popped into the book and is sticking around, you have the key, the bigger strikes every 5 points in the ES loaded. You can see them here. You can see my cursor. You can see them there, 65-ish, 69-ish. Those are areas that are likely to trade out. Not seeing like incredibly long-term pools of data of bids or offers holding on here. Again, it's new all-time high territory. We do see some aggressor type movement in bids. You see that bid moving up with the market, as opposed, that's not a market maker, that's somebody actually wanting to get filled. But overall, the order flow is going to be tricky here, new all-time high territory. We're clearly within earshot to the 3,000 mark in the ES, which I think if that happens, Wall Street will just, the stock exchange the roof will open up and a massive bunch of balloons will come out or something, as if 3,000 matters. But the market does care about these century figures, and it does give them creed. Okay, there's likely to be quite a bit offered. And since I have full depth here, let's take a look, right? Out of curiosity, what's up there at 3,000? So 2 sigma is at 82. Let's see if we have, there's 3,000, only 206 offered up there. Market's really doesn't look like anybody's anticipating it going there. There is an offer that's been sitting here quite a while. You can see the gray shadowy line. This is a smaller offer. I expected something a little bit bigger up there, but it doesn't seem to have any. This is, again, full real-time depth. So that's that. Wow, I'm going way over my time. Let's switch gears and take a look at what's expected for today. So we have to shift the chart way down, because of the gap. Starting out, it's a gap into new all-time high territory. There's a special thing about that. When you're gapping away from balance, if you're gapping into balance, the reversion, the probability of a gap reversion is much higher than a gap into new all-time high territory. The market's much more likely to be initiative. In the open, I expect the market to open up in an open auction. I'm looking for a push through the overnight high. I'm looking for an immediate response, but the overall sentiment today is likely to be to continue pushing to continue pushing this high. I'm looking for the biggest impulse of the day to be higher. I'm looking for a gap to remain open below. I'm expecting a what's called a gap and go situation here. I'm looking for the market to gap and push higher. Now, if the market does not revert, if the market's not responsive, um, uh, immediately, then all shorts are off. I'm not going to be leaning against these levels. These are phantom projected measured move levels. They're not leaning against prior content or a prior auction. So I'm not going to be leaning on these stock zones to get short. These are just targeted areas to scale out or to target. Now, if the market then opens up and it becomes responsive, in other words, it's not doing a good job pushing higher, and it takes out the high, and then we get a strong impulse down, and it's not able to push back up. It has a weak attempt to push higher. Then we're looking, then we're looking for the shorts, and we're back in range, and it gives us some reference points to trade off of and areas to lean against. So overall, the responsive plan is a little bit more forgiving, right? The probability of closing the gap zone is fairly small given the range historically, but again, we are at all-time highs. The context here to walk away with is that we're at all-time highs. There's also a high probability today of an open drive and an open test drive. The word drive in that means there's likely to be a higher time frame participating, and when a higher time frame participates, they don't really care about your day levels or your 2-day or weekly levels. They're operating on a much bigger time frame, weeklies, things like that, dailies, weeklies, and they're likely to run things over. So the best thing to do today, in my opinion, is to wait out the first 15-20 minutes, and our job is to try to detect as early as we can who is in control and how much power are they exerting in the market. And we measure power through volume. This is why volume profile is really important to me. The delta is really important to me. So I'm going to be watching that very closely to see, is there a push if it's happening on thin volume and it's not persisting. In other words, a melt up. It's going to be hard for me to participate even on the long side. But if we see that it's hammering away on the long side and it's not gaining territory in terms of price, in other words, it's lifting, and it's not able to get to the next price easily, then I'm going to look to fade that short on a scalp with a move towards at least the gap mid at this point. The gap mid is the distance between 2936.75 and where we open divided by 2. I know it's a lot to cover, but a lot has happened. And I wanted to make a few things clear. Thanks for listening. Take care.